Good day, everyone. Thank you for joining us here at Seaford and Brew for our economic briefing. We got big news this morning. We had that GDP release that came out. Before we look at the release, let's just review over what the Atlanta Fed in their GDP now we're expecting. Overall, when we look at the third quarter expectation by the Atlanta Fed, we know that in the beginning of the quarter, they were up around that 6%. They came all the way down yesterday on the 27th of October with an expectation of just 0.2%. 0.2%. And we know from this morning, GDP did pull off, did not go all the way down to that 0.2%, but we did see a significant decline quarter over quarter in terms of that growth rate. Something that we were expecting and we saw in the market. The majority of economists were projecting somewhere between 2.5% and 3.5%. Our expectation here was around between 2 and 3, and it came in at that lower end of our expectation at 2%. So I think it underwhelmed the market. I think we had overall a higher than 2% growth rate built in, and I think we'll see a little bit of pull off in some of the markets. So that's where we are today, that 2% growth rate. But let's get down into the nitty gritty, the different components of this GDP. If you recall, we have those four primary segments. We have the consumer segment, investment segment, government, and exports, imports. Overall consumer with a huge reduction of contributing just 109 basis points to the overall level of that GDP, down from where it was at 792 in the second quarter. Look at what we saw. Consumer spending increased just 1.6%. So very small increase there. And that was fueled by the goods spending down 9.2% and services up by 7.9%. So we had that pull off in that goods, and we saw that in the advanced numbers looking at the retail sector. So we knew that those numbers were pulling off, and with the autos, we saw that occur as well. In fact, the autos contributed or detracted from the overall level by 239 basis points. We saw a huge reduction in those auto sales, both motor vehicles and parts. So that was a big component there. On the investment side, we had a big flip, 194 basis points here in contribution to the overall level. And that was purely that inventories number that really popped in there, 207 basis points. Huge increase. We saw a decrease in the residential fixed investments of 7.7%. Pretty significant decrease there. And all of that has to do with the inventory factors and the supply chain just reducing down that fixed investment. Also, non-residential increased by just 1.8%. So that big move in the investment solely due to that inventories, not too surprising. We knew that there should be some movement here just because we've had such a tremendous amount of inventory reduction over the past couple of quarters. So we knew that was coming. That's a very big number. In fact, if we were to strip that out, GDP would have been negative. Kind of think about that for a moment. Government spending contributed 14 basis points from where it was last quarter at negative 36. So overall, we had a reduction in the federal spending, continue to see those reductions, but an increase in the overall level of the state spending of 4.4%. So that was a little bit of a positive. We continue to see that pull off in the federal. And then we look exports, imports, typically a detractor in terms of GDP, and we saw that come in at negative 114 basis points. So that is typical. We saw exports decrease by 2.5%, while imports increased by 6.1%. We still have that gap there, that trade gap, which kind of increased this past quarter. So overall, that's how it laid out when we look at the different components. So building this 2% growth rate in the third quarter into the models, we say, what does it mean for the 2021 GDP growth rate overall? We have actual numbers for first and second quarter in here at 6.3 and 6.7. The estimate for the third quarter at 2%. So to meet that 5.9% goal that's set by the Fed, if you recall, in September, the median estimate for 2021 GDP was 5.9%. We would have to have a growth rate of 8.12% in the fourth quarter. Highly unlikely. I don't think we're going to get that high. We'll see what it comes out as the numbers for the fourth quarter begin to come out next month, starting with October releases. So when we look at this number, that's pretty high. So most likely we're not going to meet that 5.9% expectation by the Fed. So it's going to be much lower. In fact, the IMF had it around 5.8. So we're going to see this number come back down in the December release for the Fed. When they do their new set of projections, that's most likely going to be south of 5% when we're looking at these numbers. So that's going to be pretty significant, and that kind of brings to ahead this whole thought process of how's the Fed going to move forward. You know, they're in between a rock and a hard place at this point because they have inflation that seems to be running higher than what they initially expected it for a longer amount of time, and they'll say it's because of the supply chain issues that are building that in, and that does have a factor. So hopefully we're going to start to see inflation abide a little bit, but we have also the economic numbers, this GDP seemingly slowing down in here. So they're stuck in a rock and a hard place in terms of when to start tightening their interest rate policy. On the inflation side, we said inflation has been running high. We have the PCE out of this report at 5.3% year over year. Core PCE, that's excluding food and energy, at 4.5. So we know we're running higher, and the Fed likes to look at the PCE. I think we do still have some basis issue built in here when you look year over year. So not until we get the fourth quarter numbers or we start to see the monthly releases come out so we can determine exactly how is this number progressing in terms of inflation when we look at the month over month trailing numbers. So that's what we're going to start to look at. We know CPI starts to trail off over the past couple of months with their overall level of growth in inflation. So we're starting to see inflation come down, and we know that there are some sectors that costs have increased or prices have increased tremendously, and then we're going to start to see that come back down. So is it still transitory, this whole transitory? Transitory, in fact, okay, how long are we have to deal with these increase in prices? Will it be for years, or are we going to move through this process for just a couple of more months? And that's something that we'll have to just keep on top of those inflation numbers as they come out. When we think about the Fed, they meet next week, so we're going to get some more flavor on what they're thinking about the Fed funds policy as well as that tapering. But when we look at the CME group and their probabilities for the Fed funds, we're looking at about one or two rate hikes in 2022. So that's something to think about when you're looking at your budget and you're beginning to build those budgets out for 2022 into 2023. We can almost firmly say at least one in the latter half of 22, one Fed rate hike, about 25 basis points, potentially another one at the end of the year. And that's going to give us some flavor there for where we think that rates are going to go. Now, I don't think it's going to impact your overall level of deposit pricing, though. I think we're going to be able to keep those deposits fairly low for a significant period of time. So just keep that under consideration. When we look at the new one that came out this morning, they even have, this is the first time we're seeing this, a potential third increase in 2022, but not until that December. So that's just crept in recently. Don't think that's going to be an issue. One, maybe two, we're going to see next year. But of course, they have to complete this tapering, right? They have to complete the tapering. We know the balance sheet has grown to over $8 trillion. We expect tapering to happen soon being potentially starting next month or December. We'll have good information on this next week when the Fed comes out and they have their meeting, but we expect that to happen. The question is, how fast are they going to reduce that tapering? Is it going to be by $15 billion a month, or is it going to be by something greater? I think we have some of the tapering built in right now in terms of the 10-year Treasury, but I do believe if they come out and they're really aggressive on this tapering and they're doing something like $20 to $25 billion a month in the reduction, I think we're going to start to see that impact the markets. I don't think the market is building in that quick of a pace for that tapering, but we'll see what happens next week when they come out, and we'll do a webcast on that as well. So overall, that's what we have for you today. The economy beginning to seemingly fall apart, but we do have a lot built in there because of the COVID and the Delta variant ramping up throughout the beginning part of the summer into the latter part of the third quarter. So that is that's weighing in on these numbers. So hopefully we'll start to see that pick back up. However, the question has to be asked, all the spending that we've seen throughout the first half of the year, the first 3 quarters of the year, was that pre-spending monies that we've already had given from the Fed and from the government? Was that all that money, was that spending capping out what we can do in the future? Because we're not going to need to build another deck. We're not going to need to do any of those other additional items that we've been doing over the past year. So are we taking that amount out, and how much of that is going to impact the GDP growth rate, not only in the fourth quarter, but as we look into 2022? So just a food for thought. We look forward to speaking with you next week as we look at that Fed release and what they have to say about the tapering and potentially maybe some guidance on overall level of their interest rate expectations. Have a great day, everyone. I look forward to speaking to you next week.